Today,
Yes.
we want to talk about buying real estate, investors specifically, how to invest in the climate that we're in. I remember, like in 2020, everyone was so positive of the year.
Yep.
All your goals were going to happen. Something about that number, 2020. And then we all know what happened. I feel like 2023, we're finally getting back to the point, even though I know things are kind of difficult, there is light at the end of the tunnel.
In 2024, after inflation goes away.
Yeah, for sure. By the way, that's a good starting place, because today we want to talk about buying real estate, investors specifically, how to invest in the climate that we're in. So I guess let's just start there, because last time we talked about buyers, we talked about sellers. These are just people buying maybe their first home, average residential properties, but we didn't talk about how to get the ROI, right? So where are we in 2023 right now when it comes to investing in real estate?
2023, we're moving into one of those unique years. This is a different landscape for real estate investors. And it's unique because you've got prices trending in a downward direction. You have slight down pressure on rents right now. And then consumer confidence is going, it's going down. You have interest rates up, so debt is more expensive. And then last but not least, because this one's very important to investors, is we have a credit squeeze going on. So credit squeezes happen anytime markets shift and basically lending criteria goes up, the amount of debt they're willing to give out, the LTV they're willing to give it out at, the terms.
Credit squeeze includes rates are higher too, right?
Yes. So part of the credit squeeze, the rising of the rates is what causes credit squeezes, but the credit squeeze is where they go, hey, Benji, you have a $290,000 line of credit with us. By the way, for you to continue your $290,000 line of credit, we now need to collateralize that against a piece of real estate you own. Versus the last 6 years, you were probably able to operate that line of credit without it being tagged to a piece of real property. Or they come back to you and say, hey, we're shutting it off.
Yeah.
Or, hey, it's no longer $290,000, it's $100,000. And that credit squeeze happens to the small investor, to the large mammoth hedge fund. And that's going to continue to happen. So then what happens to deal flow? Deal flow in 2023 on the investor market is basically there's just going to be less. Okay? Because as interest rates rise, we have to have compensating factors. Either the cash flow has to go up or the price has to go down. Plain and simple.
Yep. And the prices are going down, right?
Just a little bit.
Not enough?
Not enough to compensate for the rise in interest rates.
Yes.
So over time though, so in 2023, cap rates have to rise. Cash flows have to rise in order to compensate for those higher interest rates. So there will be a lot of great, phenomenal deals this year. Just have to be patient. Patience, John Skywalker. Like, just wait for that right opportunity and be ready when that shows up.
Interesting, because 6 months ago, definitely a year ago, I would not have imagined we'd be in this scenario where I personally feel it's a great time to start paying attention, right?
Yes.
Right, because I heard this from a friend of mine about dollar cost averaging. You do that with stocks, right? You do that with other types of investments. You can also do that with real estate. Of course, not everyone can buy like one property per month for the next like 24 months. Point is, you can't call the bottom. And so what are your thoughts on this theory of mine? We're starting to get to the place where the bottom might be closer than we think. Because I thought, and I think a lot of other people based off of the data and the numbers, bottom might have been like 2024, 2025.
It felt like that.
Yeah, exactly. But I feel like maybe it could be this year.
I know the Seattle Metro really well. And in our metro, it will be this year. In other metros, I can't fully speak to that as much. Here's what we know. You can go in and you can look at real estate statistics. And inside of those statistics, you will find what's called a list to sales price ratio. And there's a gap. Okay, so if a property sells for, it's on the market for 100 grand, and it sold for 98,000, then the list to sales price ratio would be 98%. What happens is the historical norm throughout the Seattle metro is in that 98% range. Right now, we're below that. So as that gap starts to close, that is an indication of a bottom. And so when we went back and looked at all the historical data from the previous recession, and the best deals, 2009, 2011. Well, the market bottomed in 2012.
Yeah.
So the best deals actually happened on the downward slide, not when it bottomed and coming up back to the other side. And specifically, I'm referring to in the list to sales price ratio of people getting the most money off. Okay. Now, there's deals a deal in any market. You can get a good deal at any time, up, down, sideways.
We're going to talk about that today.
So the market doesn't matter. The deal matters. But if we're saying like, when will the most of the deals happen? Now.
So that's my point. So if 2023 is the potential bottom for the Seattle metro area, then this is why I'm saying pay attention now.
Yes, sir.
Because you don't want to get it when it's too late. Because it's almost impossible to time the very bottom, but it's actually more plausible that you're going to get it when it's getting there.
Yes.
And then on the upswing. And we know how it's going to, it might not jump back up to the same degree as 2020, 2021 in terms of the rise in prices. But man, 5-10 years out, you're going to be so glad potentially 2023 that not only were you paying attention, you were purchasing as an investor because by the time 2024 that rise up is kind of too late. Everyone's back in the game.
Bingo.
Interest rates might go back down.
Bingo.
Prices would definitely have come down. You see what I'm saying? We're like, this is a time for people that are serious about investing in real estate long term, not necessarily the short term flippers.
Yeah. Short term will work if you've got a margin of safety. In other words, if I buy it at a deep enough discount and I've got a margin of safety, a flip would work, new construction work, but I have to have a margin of safety.
Right.
And going back to what you were saying, what people want is people want to buy when others are buying so they feel good about it. When that consumer confidence is returning and when the market's going up and the jobs feel good and their pocketbook feels good and the stock market's going up. Well, that's when everyone's trying to buy.
Yep.
So like you were saying, you got to buy on that downhill slide before then because that's where all the opportunity is. Warren Buffett.
Blood in the streets.
Well, be fearful when others are greedy and be greedy when others are fearful. So are we at a high fear, maybe even peak fear right about now? Great, time to start. Secondly, if we turn around and just kind of look at the Fed data and the CPI data, the Fed said, hey, we're going to keep it higher longer, and so be prepared for a bumpy ride. Okay, that's in the FOMC minutes. And the CPI data that just came out this week, you saw goods trending down, services trending down, shelter still trending up. But shelter, when you go into the actual shelter breaks into two components, rents and owner's equivalent rent. We know, because we're looking at hardcore data on the front end, that those indicators have already started changing. And the government is looking at historical data. So when they look at CPI is actually the rent portion only looks every 6 months. So it's moving in these big blocks. So when BLS, the Bureau of Labor Statistics, releases its data, it is 6 to 9 months old. That's why it's still showing shelter trending up. So we've actually already started beating inflation. Now, it's not going all the way. I believe that bottom part's really sticky.
Yeah.
But I believe as soon as shelter starts turning, and it's going to turn in 6 months, all of a sudden inflation is going to be in the 3s or the 4s.
For as much as we probably are annoyed with the Fed, the one thing we can give them credit for is what they're doing is naturally going to cause this squeeze in people's finances.
Yes.
And this is why, whether it's they're doing or not, or more of a macro thing, this is why CPI is coming down, because we have no choice. As investors, right? If you're buying at 2, 3, 4%, and now it's literally almost double in some cases, well, if the price didn't come down, you just can't afford it anymore,
Bingo.
right? The margin isn't there, the ROI isn't there, so you just have to wait, which basically that's what happened the last 6 months, and probably is going to happen another 6 months.
Bingo.
When that squeeze gets so tight though, right, where the numbers do come down, people are going to keep waiting because they want to wait till it's safe. For the investor, I think that's when you want to get in and start doing some things, right? Picking up some properties.
I think today, to go back to what we were talking about, 1, know your criteria by which you buy. 2, know my short-term, mid-term, and long-term goals for me, my family, and where we're headed. 3, study the market. So I know if the market is showing me it's a deal. If it's a deal, buy it. Who cares if it's a bottom? Who cares if it's up, down, sideways? A deal's a deal in any market. Buy it. But if I know my criteria, know my goals, and I know the market, then I can identify the deal. Also, be ready. Item number 4, be ready for the deal. Have the cash available. Have the credit available. Be prepared. Have some time. If I've got those lined up, then as opportunity presents itself, I can capitalize on it. Moving a little further down this pipe, you have to start playing the long game right now. And the long game as an investor is you have to start going out there and being known as the gal or the guy that does what they say they're going to do. They close. They know, like, love, and then they trust you. And then you start having conversations. So I had a conversation this morning about a 92-unit multifamily. It's on the market for $9.5 million. Verbally, I've got them to 8.5. I told them 8.5 doesn't work for me. And he says, well, what number does? Because, they've got nothing else right now because people are pulling back.
There's no options.
And I said, well, 7.5. He goes, well, they'll never go for 7.5. I said, no worries. Would you mind asking them? And then if they get mad, just say Bill Smith did it. It wasn't me. I was like, but what we do is we build relationships with the principals, the owners, or the brokers, or whomever it is, and we just keep checking back in. You want to pick the apple when the apple's ripe. And right now is just a patience game. So if we know the numbers, know the market, and then if they say yes, boom, I can go. If not, I just wait for the next one or just go find a different deal.
This is just the opposite of what happened in 2020 and 2021, right?
Yes.
Where it was assumed you're going to offer full price, if not more, okay?
Yes.
When you're in a market that's trending downwards, it's the complete opposite. The problem with someone that's not a seasoned investor, that's a professional, been doing this for a long time, you're afraid of offending them, right?
Yes.
You're afraid that it's so low they even won't reply to you. But put yourselves in the other person's shoes, the seller, right?
Yep.
If they're not getting offers, you might be the only offer, right? And so this is a matter of trying to find the bottom. We're trying to all find the bottom. There's other external factors, right? What's the Fed going to say? Yeah. What is the rate going to be? Where are prices going to finally drop? But on the way down there, it's going to be interesting how you can find great deals if you think of it in a 10-year time horizon.
100%.
Just let's just talk about this. Let's run through these numbers to give people a good example, because we all remember the crash in 2008. We don't remember the prices in 2009, 10, and 11. Okay. So what was the bottom year for prices? Would you say
2012?
2012
in the Seattle metro.
That was 10 years ago. Think about this.
Yes.
That's perfect. 2012. What was the average house price for a rental property? 3-bedroom, 2-bath. Would you say, just ballpark it?
$200,000.
$200,000 in 2012. That was the very bottom.
Yep. For a single family.
What did that house get to in 2022 at the height of the market?
$650,000.
Tripled in value.
Yeah.
Okay. We're not making any promises, no crystal ball, but it's very likely 10 years from now, even though we're not even at the bottom right now, it's only going to get better once we do get to the bottom. But even if you buy right now, 10 years out, you could easily see such a crazy appreciation, you'll feel kind of like you missed the opportunity, just like we do when we think about 2012.
If we could go back to 2009 and magically we all had a bunch of money, and if you just bought everything, you'd be loaded. Okay. This is probably your best opportunity since the Great Recession is this, COVID reset. Whatever they're going to end up calling this, the COVID recession, the COVID reset, the great inflation from, COVID, whatever it becomes, that's your opportunity. And then a lot of people, we get fixated on price. Price is only half of the investing component. The other half is terms. One of my friends in Colorado, another multifamily, sitting on the market. It's on the market for 7.5. Sitting there. Seller will not budge for any reason. What ended up happening was the seller ended up taking an owner financed offer at 7.5. So the owner was then able to get their price, and the investor got their terms. And so yes, that investor overpaid for this property for probably somewhere around 12% above the market value. The seller gave them 2.5% interest for 3 years. And then at the end of 3 years, they have to refinance. Well, what that's allowing this person to do is that's essentially now their bridge financing. Yep. They're going to do a value add, so go through, remodel, raise the rents. And what they did was they ran a conservative pro forma. Okay. So even if I could push the numbers, what if I need to put in 15% of just buffer in that bad boy. Okay. So they ran a conservative pro forma at today's interest rate, a 1/4 point above today's interest rate, a 1/2 point above today's interest rate. And they're able to make it work where there was still a margin of safety in that conservative pro forma that even if rates ticked up from where they were, they'll still be able to refinance out of it. And now they have the time to do it. Seller got their price, investor got a deal. So I think one mistake we make, and especially when we're that first time investors, we get so fixated on, I got to have X price. I'll pay you $10 million for it if I can have these terms. Well, Anton, it's only worth 7. Who cares? These terms make it work. If we can balance those things out, you'll do more deals and better deals. So once again, we already talked about this, but knowing the numbers and really running your numbers today becomes the most important part of this.
Yeah, it's always important, but it's more important now because that's where you're going to find the opportunities in a landscape where it seems like there's none.
Yes.
I want to give you kind of an example, right? And then you kind of help this person that we're going to create. Stock market isn't somewhere people feel like they're going to make a lot of money, okay? Retirement funds have just crashed basically, especially with all the stimulus and, cash on the sidelines. There's a lot of people that are just avoiding the top of the market. Yes. They want to buy at the bottom of the market. Point being, they've got cash to deploy. They just don't know when.
Yes.
That person that's looking for a long-term return, right?
Yep.
Long-term return, right? ROI on their real estate investment. What should they start considering? What are the things that they should be looking at?
I think in this high interest rate environment, cash flow is always king. Cash flow is a must, is paramount. If you don't have cash flow from the get, don't buy it today, unless we're talking about a development deal or a flip or something like that. But if we're just talking about a rental house or a duplex or multifamily, you have to have some cash flow. And then we also have to have reserves. Things change. Life happens. You buy the duplex, tenant destroyed it. It needs $5,000 worth of stuff. You got to have the reserves to fix it. So I think that's probably just the most important foundational thing that people need. And then they need to really just kind of dig into their goals again.
Yeah.
Okay. Hey, how old are you?
38.
38. Okay, so you're almost 40. Okay. 43, 38. So, a few years apart right there, but, kind of in that same age bracket. So we've got a 10, 20 year, 30 year time horizon in front of us. So our goals are going to be different than someone who's in their 20s. Mm-hmm. Also different than someone who is in their 60s. Cash flow, cash flow, cash flow. And then try not to throw all of your money into the one deal, because if you found one good one, there's probably a few more. So what I'd recommend is really go look at 10 deals, 20 deals, buy one. When the market was going up like this, you could buy any deal and still make money. The market made you look like a genius. Yeah. The rising tide was lifting all ships. It's not the case right now. So you've got to be more conservative on your numbers. So go look at 20 deals, buy one, and pull the trigger and immediately get set up to try to go do your next one.
Cash reserves is great advice for anybody for any project.
Yes.
But also is to help you dollar cost average till the bottom, right?
Yes.
Don't deploy all your funds right now, because we have a good feeling we're not at the bottom.
We're not.
It could be 6 months. It could potentially be 18 months, right?
We could go all the way into late 2024.
Totally. So dollar cost average, because I guess this is where we have to be tested ourselves on our own beliefs, right? But I am so confident that 10 years from now, we're not going to regret the purchases we make as long as they're cash flowing. Because typically when I'm investing, I'm not thinking about appreciation. That's usually just a bonus.
It's a bonus.
But that was the problem that created this big bubble, right? Because you could buy literally at the beginning of the year, sell at the end of the year, make a hoard of cash, right? Yep. And you're winning. But in this environment, not only is it cash flow, it's that's all there is.
That's all there is.
So you
have to buy cash flow, because if the value of the asset trends down another 5%, 10%, your cash flow will keep you buoyed up, and you've got to have payment terms that carry you through the down cycle. So if you buy less than 4 units and you get a 30-year fixed mortgage, well, that debt is fixed for 30 years. If I'm buying 5 units or above commercial debt, we know that debt's going to get called in 5 years, 7 years, or 10, generally 5. 5's a little scary right now. Our interest rate's going to be low enough then. So maybe I'm trying to get to 7-year debt right now just for safety on that commercial side. But let's go back to what you just said, because let's talk about just some interesting numbers so investors are on the same page. So in the Seattle Metro, basically, if you had bought in 2007, a decade later, you still made money.
Yeah.
2008, decade later. If you bought anywhere all the way down the bottom and you just added 10 years to it, you made money. In that short-term window, you lost money. And then also, everyone thinks that this recession is like, they're all the same. This is going to be just like 2008. No, it's not. Okay? Get that out of your head. Real estate is not crashing like it was. We had almost 5 years of new construction built throughout different parts of the country. Most of the country is still behind on new construction from the Great Recession. And yet there's still people moving there. And then what happens in recessions, in addition to credit squeezes, is you have the land development squeeze. So land development applications are currently trending down everywhere, and permit applications are trending down. So by 2024, and definitely 2025, and definitely 2026, the problems of 2023 that were started in 2022 of lack of supply start showing up again. So there's going to be this natural catch that, I get it. People want things to go down a lot. And I do too. I want to buy homes at 2012 prices. It's just not going to happen. There's already signs that the market in some areas is starting to try to grab a floor or a bottom. But to protect yourself as an investor, you have to cash flow. You have to make solid investments. You got to buy in the good neighborhoods. You got to buy that piece of land where growth is going. You got to buy the strip mall that everyone goes to. Don't buy the C-class strip mall, that's got the old broken nail salon and the pawn shop and something else in it. No, you got to buy the nice stuff, okay? Because if the economy does keep trending down, and heaven forbid it goes for years, Are you going to be safer in the A or the B class property, or in that C class strip mall at the edge of town next to the sewer
I want to
plant?
push back on that because if that C class strip mall is cash flowing and the ROI is there, right? Then that's what's most important, because there's probably places that are A class. I'm not very familiar with commercial properties, right? There's places that are A class right now that are too much, right?
Yes.
The expectation from the seller is so high because they're still living in 2021 days, 2022, like the beginning part. So it's the number. It is the percentage that you're getting on your investment.
It would be to get into specifics, it would be your cap rate.
Yes.
It would be your cash on cash return. And also the thing you want to look at though is with that C class and the A class, all of these, you got to dig into the leases in today's market.
Yeah.
So you go and you look at the lease and you see it's, Bill's Plumbing Supply. How many years has Bill been in business? Well, Bill's been in business 30 years. Cool. I like that tenant. Bill's been in business a year and a half. This C-class property, even though I'm getting a higher return, is actually going to end up having higher risk. So you got to dig through the returns, and your returns are our first level. Then we've got to lease audit what we have and say, now who are my tenants? Whether this is in a multifamily or in the office or retail like we're talking about. And then the third factor is, what is the condition of that building? May be able to buy an awesome cash flowing property, great tenants. What if the building needs $300,000 over the next 3 years? It needs a whole new roof across 10,000 square feet. That's the due diligence. Like, today, 2023 for investors is the year of knowing the market, knowing your numbers, having a sharp pencil, and that margin of safety. Okay. And then if it's crossing those, buy.
Sure. Hold on. Well, okay. So I want to run one more thing by you.
Yeah.
And it's this idea that we could continue to see better deals, forced price drops, because all those people that bought in 2009, 10, 11, 12, 13, 14, maybe all the way to 2019 still have equity in their properties. And what I saw some people doing, and I'll talk about the other people as well, they're seeing the prices drop and they want to get that equity out of their house, right? Because their plan was, especially if it was an investment property that was based on appreciation as the return, are trying to sell. Now, the flip side of that, and I probably am guessing what you're thinking about, is the interest rate they're getting. So what are your thoughts on these people that have investment properties that they bought at the right time? And they're going to potentially sell it for less than what they could have got in 2022. But it doesn't matter because they have so much equity in their properties right now.
Once again, where are you at in your life cycle?
Yep.
Okay, so we have some investors who are in the process of making their portfolio smaller. We have other investors who are like grow. Okay, I'm in grow mode. You're in grow mode. I mean, that's where we're at. Right now, it's going to come down to the cash replacement. So a gentleman I just spoke with has 12 units. It's 6 duplexes, and he has owned them since 2012. And they need a little love, so he needs to go put some money into it. The rents probably need to be raised a little bit. And that was his exact question. What do I do? You go in, you clean it up a little bit, you get it ready, and then you 1031 into a bigger property. But we need to make sure that you're maintaining or improving your cash flow, you're lowering your risk, and you're getting a better cash on cash return on investment. If you're not, you need to stay put. So sometimes investors get antsy and they just want to sell, because we are a little bit of deal junkies, so we want to just go get it done. We need to get it done when the numbers say it's a good time to do it. And we also need to get it done when the right opportunities are presenting themselves. So what I would be doing if if that was my property and this was my advice to that individual was, hey, start getting your property ready, start bringing those rents up, and then let's start looking for the property you're going to exchange into.
Yeah.
Let's go get that one under contract. And then we'll turn around and sell this one. Because, once again, with rising interest rates, if he's moving from a 12 unit property, and let's just say he's going to go buy a 20 unit or a 24, there's more buyers looking for the 12 than there is for the bigger one right now. Mm-hmm. And so we has a better opportunity to get that one under contract. Let's turn this around and talk about a small investor. A small investor was in my office, and they have a cute little Airbnb cabin, and rent's good, makes good return. And they said, what should we do with it? And I said, how much cash will you get out of it? They sell it. They'd have about 200 grand in cash. I said, okay, can you do more with your 200 grand in cash as this market is transitioning and create a more return and more properties? Or does it make sense just to sit there? So we talked about it, bantered back and forth, and kind of ran some numbers. And makes sense. Sell it, get the big hit, redeploy the capital. Now, in both of these circumstances, I will remember, I'm talking about younger investors with still longer time horizons. Some of our older investors right now are just trying to exit, and they just want to owner finance into the sunset.
Like treasury bills, all these other kind of very conservative
exactly.
Investments. They're not even investments. Historically, they're just like protecting the value of your money.
Yep.
Are at a higher interest rate than it's been in a long time. So you probably can explain this better, but this is another dynamic that's affecting the market right now. Yes. Because people have a place to park their money as they're waiting for the bottom, right?
With a decent yield.
Totally. Yield being interest rate. So
yes, correct.
Yeah, I remember as a kid, I could potentially put it into like a CD or something, 4 to 5%, right? Yep. We're talking the 90s, early 2000s. And it's almost laughable what the interest rates were for anything for like 10 years.
0.75.
Yeah, crazy.
0.5.
It's like, it wasn't even worth it. You might as well, this is why everybody was deploying it.
Yes.
Right now, it's getting back to those historical norms. And then for those older investors or ones that are like, hey, I don't want to risk my money. I have a place to really kind of, which this is what's nuts about it. It's not beating inflation technically, right? No. So you're still losing, but you're not losing as much as somebody that has it in a regular savings account.
Well, and people feel safe and secure. It's U.S. government debt.
And that's why, for me personally, I think that if you have money on the sidelines and you've got cash, we might not be at the bottom and things might not make sense from a cash flow standpoint, but it could really creep up on us very quickly.
In our area, in the Seattle Metro, we're probably going to bounce. Like it's just going to hit a point and it's going to go bink. Simple lack of supply. Another thing that a lot of investors, they're not necessarily thinking about, if interest rates are up, less buyers are qualifying. That's putting more pressure on rents because those would-be first-time home buyers now have to stay in the rental pool. So even though rents are getting squeezed and kind of pinched a little bit, long-term, this movement is more towards rents. Okay. And I believe, and I don't like this, but this is just what the numbers look like. We're going to see more and more renters. Well, great. You as an investor need to go buy more and more rentals to take advantage of just changing demographics.
For the person that is more bold and wants to take the risk, they feel confident that the bottom is coming up, right? Yep. Whether in the next 6 months or the 12 months, they want to kind of dollar cost average. What should that person be looking at right now? And what should they be doing if they want to invest in real estate properties that are going to be long-term cash flow? Whether
you're the first-time investor and I'm going to go do a house hack and buy my duplex, or just buy a home and move out, all the way up to I'm buying 1,000 units, same answer. What's my criteria by which I would buy? What's my goal? And then what's happening in the market? I like cars. And I don't know the car market, but if I sit there and look at Porsche 911, 964s, because those are the ones I love, I know the 964 market pretty decently just from looking at it. Well, anyone could do that in real estate too. They just sit there and they start looking at the market and maybe write down what a house, went on the market for and then what it sells for. Drive by, take a look at it. Same thing for duplexes or a 10 unit or a 100 unit. But get to know the market and what things are selling for and what the rents are going for so that you can start making decisions. And then build yourself a simple pro forma. Everyone loves these 28-page Excel sheets. If you can't make a decision with 5 or 6 numbers as to whether or not you should evaluate this property a little bit more, you're overcomplicating it. Simple numbers. And then if I make it through filter 1, yeah, cool. Maybe I go through the 28 pages. But know the market so you can tell what a deal is.
So I'll give you the goals and the criteria of an investor right now.
Yeah.
Okay. We know what the market is.
Yeah.
We don't know if we're at the bottom. We think like it could be close. It could be out a little bit, but we're in a downward trend. Okay. People are starting to wake up to the fact that their house isn't going to sell for what it did last year. But I don't think everyone is, right? Some people think,
100%.
Price is going to come right back up just like it did in the last 10 years. Okay. There's an investor that just lost a whole bunch of value to the stock market crashing basically, right? But they pulled out enough. And so they want to invest that cash into something that's performing. They don't want to do like 4% treasury bills or whatever. These other very conservative kind of investments. They want to invest into real estate. They're looking at a 5 to 10 year time horizon and they've got $500,000 in the bank. Okay. They are looking for cash flow properties right now. What are they doing in the next 6 to 12 months? If they've got that goal of having cash flowing properties and they want to beat what they're going to potentially get in the stock market, and they've got $500,000 in cash. That's just sitting in a bank account.
Take your $500,000, go buy $2 million worth of real estate. Get the best cash on cash return with the least amount of risk. But you have to know the market in order to be able to understand that. And that could be one property, or it could be 4 duplexes, or it could be 2 fourplexes, or whatever it is. In
market being that neighborhood, that city.
Bingo. Yeah. Phoenix, Chattanooga, Austin, Seattle, Yakima. I mean, I've been to all these different markets. So each one's different, right? And the real estate operates a little bit different there. But if you have capital that you can deploy, look for a deal that's going to get you the best cash flow and then the highest cash on cash return with the least amount of hassle. One of the properties we looked at, I called the property manager and I said, hey, this looks like a great property. Cash flow looks good. Cap rate looks good. And he goes, it's in a war zone. And I was like, okay, bummer. I said, well, because I'm still enthusiastic, so I'm selling myself now. Well, yeah, we can deal with that. What type of management is this going to take? Full-time, on-site management. Oh, well, that's not going to work. Yes, I just told you, it's in a war zone. Okay, perfect. Thank you very much. That's what I mean. Like, just because the numbers look good, we've got to go a little bit deeper. What's the trends for the area? What are the
you really got to do
like?
your due diligence.
In a down market, you've got to do double the due diligence. And then you need to hand it to your homie, to another real estate investor, to a friend, a mentor, a coach, and say, hey, Benji, check my math. Hey, Benji, would you buy this? And then if you're getting a thumbs up from your math and 3 trusted advisors are giving you a thumbs up, great. And then another thing you need to do, you need to go network with other real estate investors. Find out what they're doing, where their deals are coming from. And they may also have deals they're selling. You need to go network with real estate brokers. Okay? Real estate brokers quite often are hunting for deals, especially ones that specialize in investment properties like we do. You need to go talk to wholesalers. Okay? Wholesalers are hunting for deals and they want to hand them out to avid investors that they know will close. And then you have to decide right after that, do I even want to go hunt my own deals off market? Am I going to be a hardcore investor, fully committed, hunting my own deals, or am I going to stay through the MLS wholesalers and real estate investors and stick that kind of more traditional route? There's so much opportunity though. You just have to go put in some work. And that's part of it too. Investing is more work in a down market, and it's less glamorous and less sexy, and your returns will not be as big.
Initially.
Bingo. And this is where the seeds of wealth are built. This is the 5-10 year run later where you look back and you say, that changed my life.
That's where you have the options. You have way more margin.
Yes.
And it's actually way more safe
Yes.
long term, because man, the difference between buying a property in 2019 versus 2012, it's like night and day difference.
Yeah.
And that is the environment we're in. So I think that's a good place to end. And I wanted to tease the next topic.
Yes.
Because in 2023, we know that interest rates are high. So let's talk about working with banks, finding financing, or even creative financing.
Yeah.
Next time we
Perfect.
do the
Let's talk
podcast.
some more about creative financing deals and high interest rates and all that jazz.
Getting the money.
Get the money.